Hello, good afternoon to all of you. Thank you very much for giving me this opportunity to interact with you all and share with you my understanding and take few sessions on the financial statement analysis. You all have already gone through the sessions on financial statements. However, let me recap and introduce to you the framework that I will be using, and I call that accounting framework. And for that, first I will start by the definition that I'll be using. For me and for our sessions, accounting is not just recording of transaction. That's the focus of accountants, not the focus of you people who are going to use the numbers more as a managers or investors. So for these sessions, I'm defining accounting as a process of converting the business decisions into financial statements. Since you are all the executives of Infosys, one of the largest IT companies of the world and definitely of India, you might have seen the financial statements of Infosys. At least you might have used them for buying shares of Infosys, or you might have seen them to understand what the top management of Infosys is doing in their day-to-day activities. You can in fact call the top management and understand what is happening in Infosys, or you can observe the financial statements of Infosys and understand what is happening in the Infosys. Because the financial statements reflects the business decisions. So for these sessions, I'm going to use this framework that accounting is a process of converting the business decisions into financial statements. But what are these business decisions? The business decisions can be classified into financing decisions, investment decisions, and operating decisions. So as we move along, you will see more and more of the relevance, importance, and understanding of these three decisions: financing, investment, and operating. But how will these business decisions find a place in the financial statements? So the framework says all these business decisions will involve financial items, and all these financial items can be classified into these 5 categories. This classification is according to the conceptual framework for preparing the financial statements. The conceptual framework is the foundation on which the entire accounting is based on. So every decision that you take will involve the financial items, and these financial items can be classified into these 5 categories: incomes, expenses, assets, liabilities, and equity. And the financials and all these financial items will appear in the financial statements, and the financial statements are balance sheet, income statement, and the cash flow statement. So the model that I'm trying to present here, it will show that every business decision that a company takes will involve the financial items, and all these financial items will appear in the financial statement. But this process of converting the financial decisions into financial statements can be explained or in a different manner. But before I get into the process of converting, let me tell you, this process is not arbitrary. This process is governed by the generally accepted accounting principles. The generally accepted accounting principle consists of the concepts and conventions which are accepted. I'll not be wrong to say universally accepted all over the world. And the GAAP consists of the accounting standards and the relevant laws. As of now, different countries have different GAPs, US GAAP, Indian GAAP, French GAAP, but most of the countries are now converging towards something called IFRS, International Financial Reporting Standards. The IFRS is more an European community driven standards, but the entire world is making effort to converge towards that IFRS. India is also in that process. So as we move along throughout these 4 or 5 sessions, we'll get a feel of this GAAP and IFRS. But the focus of today's class is to understand the business decisions. So therefore, let me tell you how these financial items or financial decisions are converted into financial statements. This process can be explained either by the rules of the debits and credits or through the framework of accounting equation. And we are going to use this framework called the sources is equal to assets. In today's session, since you already know what are the financial statements, my focus is explaining and concentrating on the sources of the business. In the process, of course, you'll see accounting equation. In the process, you'll see financial statement. And in the process, you'll also see the accounting equation of your company, that is Infosys. When I say that sources are equal to assets, that means at any point of time, at a particular point of time, the assets of a company should have the corresponding sources. Let me take your company's example. These are the assets of Infosys. The assets of Infosys is 28,000 crores. 28,000 crores. And these assets are supported by the corresponding sources 28,624. That means at any point of time, assets of any company should have the corresponding source. We'll come back to this equation a bit later. And what are these sources? Whether it is a small firm or a large firm like Infosys, the sources are capital, retained profits, and the borrowings. The capital is a money contributed by the owners, shareholders. Profit is a money generated by the business, and the loan money is a money contributed by the outsider. Maybe we can give a broader term, liabilities. Okay, so the sources of money for a business will be the owner's money or outsiders' money The equity, which is called the owner's money, consists of the owner's fund, consists of the capital and the profit, particularly the profit which is not distributed but retained within the business. So, assets of a business are or can be financed by equity or the debt. If you see a company financing with the equity, it's possible that the business is retaining a reasonably large component of the profits year after year. So let us see how is Infosys. So question is, how is Infosys financing its business or assets? When I say how is Infosys financing its assets, at this juncture we are not trying to understand what assets are created, but we are trying to understand what are the sources of money which Infosys is using to acquire the assets. So therefore, the focus is on the sources of the business. The total assets, as we have mentioned, the total assets are 228,624 crore. So the assets of the business are financed by capital, financed by retained profits, okay, financed by retained profits, and financed by the other liabilities. At a very macro level, we can get an idea about the financing decision of Infosys, that Infosys is financing its assets mostly by its own profits. In fact, Infosys is not having any long-term loans or borrowings, so even the liabilities is something called current liabilities, which may consist of the unearned revenue. So Infosys is out and out equity financed company. So I can write down here, Infosys is an equity finances its assets more with equity. In this case, around 84% of the total assets as on 31st March 2011. So the financing decision of Infosys, as reflected by the balance sheet, shows that Infosys depends on its own profits. And what are these retained profit? Retained profit is also called accumulated profit, profit not distributed. Annually or every year, Infosys distributes part of its profit as a dividend and part retains. So as over a period of time, the retained profit keeps on increasing. The capital, which is the money contributed by the shareholders, is more or less constant unless they go to the market to raise the capital once again. So one of the important financial indicators of a business is to understand the equity of the company. As I mentioned here, equity shows capital and retained profit. So the equity of a company, if I just use the equation, so I say the sources are equal to, let me see if I have that, okay, the sources are equal to assets, and the sources are equity plus liabilities equal to assets. So equity is equal to assets minus liabilities. That is why we define equity. Equity is a residual amount. Equity is a residual amount. Whereas liability or debt for the time being is an obligation, is a contractual or statutory obligation. So when we say equity is assets minus liability, or equity is equal to capital, equity is equal to capital plus reserves, okay, or retained profits. Sometime the retained profits may be, if it's a loss-making company, then this will become accumulated losses, and it's possible that the accumulated losses may be much higher than the capital, so equity may become negative. Let us see this. So in this case, equity of Infosys, if I say A minus L, equity of Infosys is equal to A minus L. So equity is equal to 24,095, or I can also say equity is equal to capital plus retained profits. So therefore is 23 plus 2. So we can find equity either by deducting the liabilities from the assets or by adding capital to retained profits. But in both ways you should get the same answer. So equity is excess of assets over liabilities, or equity is a capital plus reserve. But you see this another hypothetical company where we can see that equity is the negative. Okay, equity is equal to, equity is negative, and equity is negative because the accumulated profits or accumulated negative profits is more than the capital, or because the liabilities, the business has to be funded by huge liabilities. So therefore, one of the important financial indicators which will reflect the fundamentals of the company, which will reflect the strength of the company, is the equity. Observe equity over a period of time. If equity is increasing, observe why it is increasing. If it is because of the profits, then definitely we can say that the business is financing its assets with own profits, and because it is financing its business with their own profit, it may not be depending on the debt so much. So a company with a positive equity continuously rising can be said to have strong fundamentals. A company with a weak fundamental is one which may be having a negative equity. In fact, a company with a negative equity is also called the sick company. Thank you very much.